The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alistair McLeod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alistair McLeod on behalf of Gold Money, and with me on the phone from San Francisco, I've got Bob Wenzel of the Economic Policy Journal. He is a prolific blogger, and I must say, I've got him on my Google Reader, and I do recommend our listeners do the same. Welcome to the show, Bob.
Hi, Alistair. Great to be here, talking with you.
It's great to have you on the show. Now, I must admit, when I look at what's going on with zero interest rate policy and all the rest of it, the whole thing is an enormous mess. Or have I got something wrong?
No, as a matter of fact, that might be an understatement given what's going on. We have a Federal Reserve that's printing huge amounts of money here in the United States. A lot of it has got into something technical called excess reserves. So it hasn't even hit the economy yet. When that does, I expect exploding interest rates and also inflation. Plus, we've got the debt problem. So anywhere you turn, Alistair, it's a major mess ahead of us.
Yeah, absolutely. I mean, I sort of look at this ZERP and I just can't believe it. I mean, it funds the deficit and cheaply. That I can understand. It artificially supports collateral assets in the banking system. That I can understand. But they're destroying savings. They're allowing malinvestments to persist. It suspends economic progress. Therefore, there's no economic recovery. There's no improvement in tax revenue on the horizon, therefore. Therefore, you're bust.
Yeah, there's no question about that. And the key, again, not to get too technical, but these excess reserves are very important. And Charles Plosser, who's the president of the Philadelphia Federal Reserve, has recently come out and stated, we don't know, meaning the Federal Reserve, we don't know how to handle all this money that's in the excess reserves. When they start moving into the economy, there's about $1.5 trillion there. When that starts moving into the economy, he says he fears a great inflation. So for that to come from a Federal Reserve president is very, very unusual.
Yes, that I agree. It's very worrying. I mean, you've only got to look at a long-term chart of these excess reserves and see that normally they run at, sort of virtually nothing. I mean, 20, 30 billion. Yeah. And now, I mean, we're what, 1.5 trillion or something? It's incredible.
Yeah, it's Alistair, it's a case we've never seen anything like this. There was a period when excess reserves did go up a little bit in the 1930s, but not to this degree. And since I've been watching the excess reserves, like you said, they've never been really greater than 30 billion until recently under Bernanke, when they've gone up to this 1.5 trillion after you started paying interest on them, and it attracted all the money there for the bankers to put it there. But then what happens when interest rates start to go up a little bit, or bankers start to see more attractive opportunities in the economy and start to remove that from the excess reserves and put it into the economy, it's going to be an explosion on the upside. And today, Alistair, one of my posts at economicpolicyjournal.com was about the fact that Carlyle Group, which is a major insider group, George H.W. Bush the senior, was an advisor to Carlyle Group. James Baker, John Major was also an advisor, and so you can get the sense of the kind of insiders these guys are. And they just made a multi-billion-dollar purchase of a commodity firm. So they apparently are expecting the same kind of inflation that I am and other people who are watching Fed activities are.
That's a very, very important statement. I can certainly see that. You also had on your blog today an interview which CNBC did. Was it CNBC with Kyle Bass, which I found quite interesting. And he again, I think, is sort of rather shrugging his shoulders and saying, well, I can't fix it. I mean, I'm an accountant. I've got no answer. So how can they fix it?
Exactly. I mean, he made a key point saying, he looked at the numbers that are put out by the Congressional Budget Office, and he said he took his pen to the paper and said he couldn't figure out how to get out of the mess. And he's an accountant with no partisan leanings one way or the other. And so he's saying when you have these Democrats and Republicans there who have partisan goals on top of it all, that there's no way that this budget thing can be resolved. And it really comes down to either there's going to be a major default, which is a small possibility, or the greater possibility is the Federal Reserve, Bernanke, just prints money and eventually destroys the currency.
Well, effectively, the country's in a debt trap, it seems to me. And there was another interesting aspect to this. I mean, this is interesting in the sense of watching someone hang and seeing how they die, I think.
Right.
Right. And that is someone on a Bloomberg article, which was picked up by Gary North, estimated that the increase in net present value of off-balance sheet liabilities for the government, which you would account for in a commercial company under GAAP, increased by 11 trillion in the last year. The CBO is sort of playing around with figures like budget deficit of 1.2, 1.3. I mean, it's getting dwarfed by this sort of elephant that's coming up, in the outside lane. I mean, when is that going to hit? We've just got a new fiscal year, I think, haven't we, in America? I mean, is it? Yeah.
Yeah. That's a very, very good point. There's two parts there. First of all, is just the whole idea of government accounting. I mean, they hide so much and do so much in deceptive ways that they're underreporting debt problems and things like that. If you talk to any accountants that specialize in government accounting, they just shake their heads. Now, if you look at specifically where they're hiding stuff, I think the major problem is, or one of the major problems is with Social Security. Because most people, if you talk to them, will tell you that the problem in Social Security doesn't come till about the year 2023, and that's when the Social Security Trust Fund will run out of Treasury bills and Treasury bonds to sell to make payments. But the real problem started about a year or two ago when the Social Security Trust Fund went cash flow negative. Now, what that means is up until a year or two, the trust fund was taking in more money than it was paying out. Now what's happening is they have to start selling their Treasury securities to start making some of their payments. And the way they sell them is they go directly to the Treasury, and the Treasury pays them out on it. But the problem is the Treasury doesn't have any money. They have to go out and borrow the money whenever the Social Security Fund presents them with securities. Now, it's a small amount right now, but in the year 2017, it gets to be a big number. And that's when the real problem comes in, and the Treasury is going to have to borrow tremendous amounts of money, billions upon billions, just to make payments for the Social Security, never mind what the deficit is at that time, what happens with Medicare, or anything else. It's much closer than people expect. We might have a couple of years here, but not much more than that.
Well, a couple of years is not a lot. Does this growing deficit in the trust fund? I mean, is this on top of the budget deficit, or is it included in the budget deficit?
No. In the way the political world is looking at it, the senators, the members of the House, and budget people, they don't see this as a problem at all, because they see on the trust fund's books Treasury securities. So they say, oh, okay, we don't run out of Treasury securities until the year 2023. But the key part is, and I got this, by the way, from senior people who understand this budget thing, and they agree with me that the problem really comes in as the Social Security Trust Fund has to start putting these securities to the Treasury Department, saying, give us money because we have to pay it out. And they're starting to do that now. The trust fund has gone cash flow negative, but the numbers don't really get big until the year 2017. My suspicion is it'll be even closer, somewhere in 2015 and 16, but the way they've got even those numbers figured, it's 2017. And at that point, it's going to be a tremendous burden on the Treasury Department to go out and borrow that money in addition to financing the deficit on top of it.
So this is quite extraordinary. So we're looking at welfare costs here. We're only looking at social security. Now, presumably, the forecasts, which this is outside the budget, it appears. The forecasts assume that unemployment is not going to rise and it's not going to be worse than sort of 7 or 8%, and it might even get better. I mean, what sort of assumptions are behind the idea that this isn't going to be a major problem for another couple of years?
Yeah, you're right. And another way the problem gets bigger is because the states are also having problems raising enough revenue to meet their requirements. The state of Illinois, the state of California here, New Jersey, Florida, these states all have problems which will start showing up in the next couple of years. I mean, anybody who does the accounting and just looks at the numbers, it's sort of like somebody that has a rent payment due at the end of the month, or maybe 2 months. They'll get an eviction notice or something like that, so they can see it coming. They're not quite evicted yet, but it's going to happen, and that's where these states are. So the government's been putting money in them. As a matter of fact, in some cases, they've been advancing welfare payments and unemployment payments that the states make. The federal government has been doing that, but the numbers again get tremendously bigger in a couple of years, and there's just no way, given the current situation, that they're going to pay that off. The only way they'll be able to pay that off is if the Federal Reserve and Bernanke start a major inflation push and make the dollar cheaper, so it's easier to get dollars to pay off the fixed debt.
Yeah, but the problem with that, I mean, a lot of people sort of try and persuade me, well, the answer basically is to inflate the debt away. But the problem is you can do that if you're not running a huge, great budget deficit, because all that happens is your budget deficit in nominal terms just sort of skyrockets.
Yeah. Alistair, I don't mean to say at all that the Federal Reserve pumping this money in is a good thing. I mean, it's going to be a serious inflation if that's done at double-digit rates. And what will happen immediately at that point is interest rates will start to rise, including interest rates on Treasury bills and bonds, which will mean the Treasury will have to borrow it at higher rates, causing an even greater deficit. So it's a tiger by the tail type of thing. What happens is the Fed starts to print, inflation goes up, this causes interest rates to go up, which means the deficit gets even larger for the government, for the Treasury, and they have to borrow even more money, and the Fed prints more money. It's a very, very dangerous place to be, very dangerous. And then the alternative is default. Those are the only two possibilities. Like Kyle Bass said, there's no way out of this.
Yeah. It's a debt trap. It's as simple as that. I suppose, to be fair to Bernanke, he has seen the rising interest rate problem insofar as through Operation Twist, he's locked in low long-term rates for the U.S. government. But beyond that, I don't think there's much he can do, is there, other than just bring the whole thing to a shuddering halt?
Yeah, very true. And you bring up a good point about him allowing the Treasury to get in there and borrow at longer rates, and that's probably what Operation Twist was all about, although he sold it as something as helping the economy. But he wrote a paper. There are two Federal Reserve economists in 2005 that wrote a paper. There was an earlier Operation Twist done during the Kennedy administration in the 60s, and these two Fed economists wrote a paper saying, well, it didn't work. There's no evidence it worked. Possibly if you tried it on a grander scale, you might get a different result, but there's nothing here to write home about. And one of those was Bernanke. So you have to scratch your head. Yeah, you have to scratch your head and say, what is this guy up to? Well, Operation Twist doesn't work. And the only thing it did is allow the Treasury to lock in some securities on a longer term basis.
Right. Well, actually, I mean, we're sort of talking about the Fed. Am I right in thinking that some time ago you got a surprise invitation to go and speak to the economists at the Fed? And they had absolutely no idea about Austrian economics. Have I got that right? Tell us a little bit about it.
Yes, it is. I did speak at the Federal Reserve, and what happened was before the financial crash in 2008, there were two economists. This again happened in about 2005. Two Fed economists by the name of McCarthy and Peach wrote a paper saying there was no housing bubble. And I wrote a rebuttal to that saying, these guys are so wrong. They're going to be so embarrassed. It's going to be, they've made the greatest mistake that is only comparable to the one made by Irving Fisher in 1929 when he said the stock market wouldn't crash. Okay.
Yeah.
And they got such a kick out of my quote that when they went around the country on a roadshow explaining why there wasn't going to be why there was no housing bubble, they quoted me as an opposing view, and I'm sure they got chuckles in the crowds from that. But of course, we all knew what happened then with the housing bubble. So what happened was one of the other Fed people wrote a paper saying that the Fed did get it wrong as far as the housing bubble, and there were a couple of people that recognized it, and they mentioned two people, one of them a Keynesian, and I wrote this guy and said, hey, what about me? I'm the guy that rebutted the paper in 2005 when it happened, and you sure noticed me then saying it was a opposing view. So anyways, to make a long story short, they invited me to speak on my views, and I was just shocked after my presentation, some of the questions that came up, because I come from the Austrian school of economics as opposed to the Keynesian school. And they said, oh, I know who you guys are. You guys are, the Austrians are the guys that have that formula PV equals MT. Well,
sorry.
Yeah, exactly. It turns out that what happens is it turns out that what happens is that's the Chicago school. So what that means is not only do they not understand the Austrian school, they don't even know the Chicago school if they don't understand that the equation is a Chicago school equation. And it totally, knocked me for a loop for their lack of understanding, and they just didn't understand any of the methodology that goes along with Austrian thinking, or they just don't get it. I mean, Austrian knows all about Keynesian thought and where Keynesian thought is wrong and what he thought, but these guys, I mean, they just really don't have a clue.
Yeah, I found very interesting because there's so many parallels elsewhere. I mean, I just imagine our Chancellor, George Osborne, maybe coming up with, sort of an Austrian type idea, and then putting it to his civil servants in the Treasury, and the response. And I guess that they are as aware of Austrian economics as the boys in the Fed. I mean, how can a politician actually get proper advice when his in-house economists don't actually understand, firstly, the question, and secondly, the solution?
Yeah, Alistair, very, very true. I can bring up another situation that happened with me. I attended a meeting where Phil Swagel, who was the Deputy Treasury Secretary to Hank Paulson, spoke. And after there was a Q&A, and I asked him, in 2008, in the summer, I was warning aggressively on my blog site that there was a crash coming because Bernanke had gone from double-digit money printing of 15% plus to almost zero. And for that kind of change to happen over just a few months, you knew the economy was going to crash. And all summer long, I was warning about it. So his Swagel, who is Hank Paulson's top economic advisor, he's the Deputy Treasury for Economics, I raised my hand and I asked him, do you know what the money supply did in the summer of 2008? And he says, no, but we have guys at the Treasury that, watch that. I said, no. I wouldn't let him get away with it. I said, Do you know what happened to the money supply? Was there anything unusual? Did anybody alert you to anything unusual happening to the money supply in the summer? And he had to admit no. I said, well, what if I told you the money supply went from double-digit rates of growth in the early part of 2008 to near zero in the summer? Do you think that would have had an impact on the economy and something that you would have alerted the Treasury Secretary to? And he admitted that, yeah, that's something he would have. But he wasn't even looking at that. They're just in a completely different world. Keynesian model where they don't look at anything that really goes on in the economy. And of course, they have really political agendas versus, real economic agendas.
Yeah, your story, I'm afraid, rings so many bells, bizarre though it may seem. If we can turn our attention slightly to the politicians, who I would have thought, whatever their pressures, must have some sort of idea about, life in general and all the rest of it. Now, we've got this fiscal cliff coming up. Are they going to actually go ahead with this, or are they going to rat out of it?
Yeah, I suspect they'll come out with some kind of deal, but there really is a fiscal cliff. I mean, there is a tremendous problem, but they're playing it up so they can set us up for higher taxes. That's what I see coming in here in the United States.
Tax the rich, yeah.
Yeah. Well, and the rich will be, one level above anybody that's out on the street. I mean,
yeah, exactly.
That's
yes.
the definition of rich.
But it's taking, but that is just taking productive money out of the economy and redirecting it into bureaucracy.
Exactly. Absolutely correct. I mean, that's the major problem with which people don't get, that when this money doesn't come out magically. I mean, it's being taken out of people's pockets who would spend it in ways that will make decisions where they see something good happening for themselves, and giving to a government which is run through a bureaucracy, and then given in all kinds of ways that don't make any economic sense, because you really can't judge economic value when it's a bureaucrat making the decision. I mean, in the United States, they have something here called mailbox, etc., which is a sort of a private postal service to the degree they allow it. And what these people do is they open up, small shops in convenient locations and all that. And you compare that to what the government bureaucracy did before with the post office, and you have these mammoth buildings with huge plots of land and huge buildings that make no sense. And you see the difference on how the private sector treats something like that versus the government.
Yeah.
And of course, the government never makes any profit on it. And, they're always crying for more money and bailouts there too.
Yeah. So, this fiscal cliff thing, this is going to be debated fairly soon, isn't it? I mean, presumably as soon as the election is out of the way.
Oh yeah, that's right up there. They're all going to be talking about it. And see, the dangerous thing is, in one sense, they're correct that there is a problem here. I mean, the finances are not there, the revenues are not there to pay for all the things the government wants. But the real answer is to cut back on the government spending dramatically. And as you point out, it's inefficient spending, and leave it to the individuals and let the economy boom. But that's not what's going to happen. They're going to promote this fiscal cliff as something dangerous that's going to push the economy over a cliff unless they raise taxes, which of course is what's going to destroy the economy.
Yeah, I see an echo of that in Spain, I must admit.
Yes.
Oh dear. So how's the economy going to behave, do you think, in the new fiscal year? I mean, is it going to sort of, is GDP? I mean, I reckon that GDP is a totally false statistic. All it is a measure of the amount of money in the economy. Now, if some of that money you were referring to, which is sitting at the Fed in the form of excess reserves, actually leaks into the economy, it's going to create the illusion of an economy which is growing. But that is pure illusion.
Very correct.
So what I'm just wondering, Bob, is how do you? I mean, taking that into account, how do you see the sort of the GDP numbers over this?
You're going to get that. you're going to get that false strength in the economy, especially if the money starts coming out of the excess reserves and the new money that Bernanke's printing in, if that starts to go into the economy. Now, you're starting to see some indications the housing market is getting stronger. Prices are going up. But that's more right now from a supply factor versus people increasing the demand for housing. The inventory of houses across the country is very low. It's about it's under 6 months, and in California, there are parts of California where there's less than a 2-month supply of housing. So there's some shadow inventory behind that, but for the most part, there's not a lot of housing around. So you'll start to see those prices go up. As those prices go up, what I expect is there'll be more people willing to buy when they see the prices going up, going to the banks and willing to pay a little bit higher interest rates. So you start your interest rates starting to go up, and that will give the banks incentive to start issuing some of that money that's in the excess reserves. And then we start to get that artificial boom, followed very, very closely by strong overall price inflation. Because you've got two factors. You've got the drought, which is going to have impact on meat prices next year, because a lot of farmers are sending their cattle and hogs and all that to market early because they don't want to spend the additional cost that it would require to feed them with the drought. So next year, by the middle of next year, maybe a little sooner, you're going to get climbing meat prices. And at the same time, if the housing market starts to cook up a little bit, and then you get the money coming out of excess reserves, you almost have a perfect storm for price inflation, much greater than most people expect.
Yeah, I think that's interesting. I'm interested that you place that emphasis on the housing market. I mean, I sort of I can sympathise with it, because really what Bernanke's done is he's said to everybody, now, the cost of borrowing on your mortgages is not going to go up for the foreseeable future. It's going to be at 2%, 3%, whatever it is, because I own your bloody mortgage. It's as simple as that.
Right.
So I can see that that sort of stability is likely to create a little bit of a false sense of security, as it were. But I don't really see it going all that far. On talking about food prices, that one I think is an interesting one, and I'd like your view on this. It seems to me that all this money being thrown around by the Federal Reserve, it's in the past when they've done previous QEs, it's gone into the derivatives bubble, it's gone into the government debt bubble, and some of it might have leaked into the stock market insofar as it supported prices and people have been able to take money out to pay down their debt, this sort of stuff. This time round, I think that the debt bubble can't really go much further. I don't see that there is the upside in bond prices. Do you think that the traders in the banks are likely to redirect their interest at things like grain prices, which has got to be a no-brainer?
Yeah, no, that's clearly what's going to happen. The bubble that is now in the bond market is going to crash. There's no way the interest rates can stay this low, given what's going to happen with especially with what I see in the housing market and the food market and all that kind of stuff. And then what you have is this stuff starts to go up. What you're going to have is what the traders call risk on, where they move stuff out of the treasury market into hard assets, whether it's gold, silver, other commodities, and then you get your run there, and that will start pushing the bond market down and cause assets to go up at the same time. And again, I have to point to Carlyle Group, which is now making a major multi-billion-dollar acquisition in the commodity market, buying 55% of Vermilion, and you have Glencore, your major commodity trader, making acquisitions wherever they can. They've just bought some grain elevator property. I'm sorry.
Yeah. Sorry, no, you're right. But they're also tying up a merger with Xstrata, a big gold mining.
Right. Exactly. Yes. Yeah. I was going to. The point is that they're doing grain elevator and also some ports in Russia, and then the gold mining stuff with Xstrata. I mean, all the indications on the major players are lining up for massive price inflation coming. They clearly see it.
Yeah, this is so. Yeah, I think whichever way, whether it's sort of people happy that houses are no longer going down and they flash the money around, or whether that sort of there's a bubble coming, if you like, in the grains and so on. I mean, it's not a good outlook, I must say. Coming back to something you said right at the beginning, the outlook really is either one of I suppose deflation, bankruptcy, or inflate. Just print, and inflation, stroke hyperinflation. I can't see how it's one or the other. We get both, don't we? Because I mean, surely these conditions are bound to end in a collapse in the purchasing power of money.
Yeah, that's really the most likely scenario. There are people who argue that the government will not print this way because the banks just don't want the currency destroyed, and they're going to take the hit on a default right away. I don't see that as the most likely scenario. I recognize it as a possibility. I don't rule it out because it can certainly. I can see the theoretical thinking behind it that says, okay, this can happen this way. But throughout history, what central bankers tend to do is print money when the economy is in trouble, and that will lead to the destruction of the currency ultimately. And that's generally the way it happens. And what I say is I just watch the numbers. I watch what they do. There's generally enough time to position in advance before they make a move one way or the other. And we're really right at an inflection point right now. We'll know pretty soon what's going to happen in the next round, which I suspect will be an inflationary round. But you're right, and the most likely scenario is the destruction of the dollar, the end of the dollar as a reserve currency, and that's a whole other problem where all those reserves by all those central bankers around the world, if that stuff starts to come out of the vaults and starts to hit the United States shores, that's another inflation push that could hit the United States.
Well, yes, we don't really have time to go into that in any detail, but I have a feeling that trying to, if you like, destabilize Iran is actually having very nasty potential effects, because Iran is the main supplier of oil to China and to India. They are now trading their gold for oil, or certainly on their net trade balances with Iran, and it's accelerating. I think the risk is accelerating the Chinese attempts to get away from depending on the US dollar as its international settlement currency, and so the moves are already afoot and they're being accelerated. I mean, would you agree with that analysis?
Yeah, Alice, you're correct. You're correct on that. Basically, what's going on now in Iran, the currency has dropped by 50% in less than a week. There's a near hyperinflation there. I'm getting reports from some of my people. They suspect the United States government, possibly Mossad, who knows, someone is behind it, adding currency for the decline to be this severe, this quickly. I mean, part of the decline is certainly because of the sanctions that the U.S. has put on in the rest of the global community on Iran, which makes the currency less valuable on international trade. But the internal inflation you're seeing now at this point indicates that someone is attempting to destabilize Iran, and you're seeing civil unrest, and it probably will continue and intensify from here. And like you said, that causes problems for China. It's a major geopolitical jigsaw puzzle here, and how things move from here. It's really unknown, but all this destabilization throughout the Middle East is very, very dangerous because it's too complex for anybody to understand. There might be operators in there attempting to get the destabilizations going, but once they happen, they're on their own, and you don't know how it's going to end up.
No, I think that's right. Just sort of one last topic, very briefly. Our listeners are obviously very much concerned about whether they should protect themselves with gold and silver, and that's why they come to us. What are your views on gold and silver, Bob?
Yeah, I consider them important long-term investments, and I consider gold and silver the real monies that could actually sort of save the world and save civilization. You see what's happening in Iran here with the civil unrest because of the hyperinflation going on with the Iranian currency, and that gets serious when people can't trade and exchange. Well, if people have gold and silver, and that's more apt to be in the United States and Great Britain, places like that, there's an alternative medium of exchange when the currencies go crazy, like like Iran's currency is now. One note with regard to gold and silver, I met with Ron Paul last year when we talked about gold and silver, and he actually thought that they're both going to go up dramatically, but he thought that silver would probably go up quicker than gold because he felt the price of gold is going so high that a lot of people, it will be out of their budget, and they won't be able to buy it, so that they'll switch to silver, and that will cause silver to go up even quicker than gold. But I'm bullish on both. Ron Paul is certainly bullish on both, and it could save the civilization, Alistair.
Yes, I think the way I view it is that gold and silver throughout history has been the money of society's choice, not government's choice.
Correct.
And
yes.
we have government's choice, a monopoly forced upon us. And the difference between the two is that within the writ of a government, they can force you to use your money, but it actually has no value outside their writ, beyond their writ, and it'll only be sold by foreigners because it has no value whatsoever. Gold, on the other hand, has value everywhere. So,
right, correct.
Go on.
Yeah, and the key is the government can't print gold when they want to, but the government can print paper and add zeros. And throughout history, they've destroyed currency after currency, and they can't do that with gold. That's why they hate gold so much. But gold is the real protector. And what it does is, as we've seen, is it tends to go up against paper currencies because paper currencies are just being inflated all the time, and that's not done with gold. But the increase in gold on a annual basis is minor compared to what the inflationists do with paper money.
Yeah, absolutely. I mean, I think, gold, obviously it increases. At the moment, it's increasing by 2,600 tons a year on about 170,000 tons of stock. But at the same time, the population is increasing, so the two things sort of cancel each other out in a sense. And, so it holds its purchasing power, basically.
Yeah. Go ahead.
This has been very, very interesting, certainly for me, Bob, and I'm very grateful. I mean, I've taken 40 minutes of your time, and before we sign off, your site is economicpolicyjournal.com. Is that right?
That's correct. Yes.
Is there anywhere else where our listeners can find you?
No, that's sometimes I write at other spots, but I will always reference where I'm writing at economicpolicyjournal.com. So that's the place to look for me, and that's where I write on a daily basis, 7 days a week.
Well, that's fantastic, and as I said earlier, I've got your site coming through my Google Reader, and very, very interesting, sometimes entertaining, but always interesting, I must say, and I'm very grateful for that. And so, thank you very much indeed, Bob.
Okay, thank you very much, Alistair. Enjoyed it. Great questions. A great discussion.
Thanks very much.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section. The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alistair McLeod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alistair McLeod on behalf of Gold Money, and with me on the phone from San Francisco, I've got Bob Wenzel of the Economic Policy Journal. He is a prolific blogger, and I must say, I've got him on my Google Reader, and I do recommend our listeners do the same. Welcome to the show, Bob.
Hi, Alistair. Great to be here, talking with you.
It's great to have you on the show. Now, I must admit, when I look at what's going on with, therefore there's no economic recovery, there's no improvement in tax revenue on the horizon. Therefore you're bust.
Yeah, there's no question about that. And the key again, not to get too technical, but these excess reserves are very important. And Charles Plosser, who's the president of the Philadelphia Federal Reserve, has recently come out and stated, we don't know, meaning the Federal Reserve, we don't know how to handle all this money that's in the excess reserves. When they start moving into the economy, there's about $1.5 trillion there. When that starts moving into the economy, he says he fears a great inflation. So for that to come from a Federal Reserve president is very, very unusual.
Yes, I agree. It's very worrying. I mean, you've only got to look at a long-term chart of these excess reserves, zero interest rate policy and all the rest of it. The whole thing is an enormous mess, or have I got something wrong?
No, as a matter of fact, that might be an understatement given what's going on. We have a Federal Reserve that's printing huge amounts of money here in the United States. A lot of it has got into something technical called excess reserves, so it hasn't even hit the economy yet. When that does, I expect exploding interest rates and also inflation. Plus, we've got the debt problem. So anywhere you turn, Alistair, it's a major mess ahead of us.
Yeah, absolutely. I mean, I sort of look at this ZERP and I just can't believe it. I mean, it funds the deficit and cheaply. That I can understand. It artificially supports collateral assets in the banking system. That I can understand. But they're destroying savings. They're allowing malinvestments to persist. It suspends economic progress. And see that normally they run at, sort of virtually nothing. I mean, 20, 30 billion. Yeah. And now, I mean, we're at what, 1.5 trillion or something? It's incredible.
Yeah, it's Alistair, it's a case, we've never seen anything like this. There was a period when excess reserves did go up a little bit in the 1930s, but not to this degree. And since I've been watching the excess reserves, like you said, they've never been really greater than 30 billion until recently under Bernanke, when they've gone up to this 1.5 trillion after you started paying interest on them, and it attracted all the money there for the bankers to put it there. But then what happens when interest rates start to go up a little bit, or bankers start to see more attractive opportunities in the economy and start to remove that from the excess reserves and put it into the economy, it's going to be an explosion on the upside. And today, Alistair, one of my posts at economicpolicyjournal.com was about the fact that Carlyle Group, which is a major insider group, George H.W. Bush the senior, was an advisor to Carlyle Group. James Baker, John Major was also an advisor, and so you can get the sense of the kind of insiders these guys are. And they just made a multi-billion-dollar purchase of a commodity firm. So they apparently are expecting the same kind of inflation that I am and other people who are watching Fed activities are.
That's a very, very important statement. I can certainly see that. You also had on your blog today an interview which CNBC